Very good. Welcome, everybody. I'm Giuseppe Basile, also known as the FibStalker. And today I will be your host. This is the FibStalker FX Street weekly show. It's a show we do every week. And the title of the show, it's not a review of past recommendations, but rather today we're going to touch on a number of things. First of all, as you know, I like to split the show in different sections. The first section is always an educational section. Today is December the 7th, 2016, and the educational section is going to be entitled How to Reach Trading Objectives in Money Management. This is a very, very important topic, and there is a lot of misunderstanding, if not plain ignorance, about risk management and money management, and what is the role of each. Some people believe that trading objectives, which could be a performance objective, like so to say 50% in 1 year, it's to be obtained through proper risk management. The reality is that it should be obtained with proper money management, and there is a difference between the two. So I will show charts, and as usual, I want to remind you that I'm merely providing this material for your general information, and always do your own analysis. I will not talk about myself. I will just say that recently we have successfully launched the Winning with Algos community, and I'm offering a free package that includes a trading course of a little bit more than 6 hours. Also offering an ebook, and I will be offering 1 month of free trading signal service as well. So stay plugged in, because I'll provide more information as we go. This is my contact information. You can always reach me out at fibstalker@gmail.com. Today I'm going to talk about money management. There is particularly one research paper I wrote back in 2010 and then adapted in 2012, and it was published on the Journal of the Italian Society of Technical Analysts, and recently on the Journal of the Canadian Society of Technical Analysts. So, how we reach trading objectives with money management. This is very, very important, and I want to touch on this. If you like this content, you can always tweet the link on your Twitter account. So, before I get there, I mentioned the free trading course, and you can actually get access to the free trading course at winningwithalgos.com/start, and it's free. You can register, and let me know what you think about the content. Okay, so before we talk about money management, let's briefly touch on risk management. What's risk management? It's a way to protect our precious capital, and this is rule number 1 of trading, PPC, protect precious capital. It's also a way for the market to tell us that we are wrong, and we have to get the hell out of the market. Particularly, I'm very strict on this. And it's also a way that we can get to help sticking around until we learn the trading game, and this is very important as well, because as the money is gone, the game is over. So how do we practice it? There are different ways. There are ways to manage risk, of course, directly on the trade. There are ways we can set up a process that helps us manage risk. There are different aspects, but the very first aspect is to accept risk. And it is always very important when we deal with trading, which is just a different flavor of business, just a different business, to look at all the risk and to look at the downside. Or if you are working in London, look left for the car coming in a direction you usually do not expect if you live in the Western world. So another way is to risk 1% or less. Sometimes people laugh and some people say, well, you know, I have risk capital, so my risk is going to be 5%, 10%, and I say good luck. And I also add that probably they do not understand what the market can actually be. The market is a beast, and most importantly, there's no need to take these risks in order to do very well in the market. And I'm gonna show this to you today. And another way to manage risk is to trade only after price confirmation. If you have a way to confirm price, to confirm whether an area is getting participation, and if you don't have it, consider joining my FibStalker Methods coaching program, where I will guide you to develop a complete edge that includes also price confirmation, not using the common methods, breakout methods, and so on, but you're going to look at how algorithms are actually placed on the counter trend move in the smaller time frame, and when they give way or not give way to the developments of price on the larger time frame. And another way would be to adopting a free risk trade approach. I spoke about free risk in the past weeks. So you can go back and you can go on FX3, look for Giuseppe Basile, my name, and you will find also a couple of videos in which I spoke about free risk trade approach. And that's basically, if you watch the educational section the last 3 weeks, you will find a lot of information on that. Now, in order to speak about risk and money management, we also have to keep in mind some basic trading statistics. Most of you know this. A lot of people completely ignore this information. Of course, everybody speaks about reliability, right? We want to be right. It's our ego. We're all machos. We want to be right as much as possible. Possibly 100%. This is impossible, so just forget it. No method will give this to you, and you need to live with losses. You will need to live with them. Expectancy is a simple, very simple formula that expresses basically how many dollars I can make for every dollar risked. For example, if expectancy is 1, which would be a good value for the expectancy, can be, of course, higher and can be much lower as well. That means that for every dollar I risk, I make $1. Now, if let's say that you have $10,000 and your risk is 1%, okay, that would mean that you risk on each trade, you risk $100. Well, every time you reach $100, the expectancy is telling you, if the expectancy is 1, it means that you make $100. Now, this formula of expectancy is created in a way that it expresses what you earn in average, also on the trades where you risk 100% and you lost 100%. Okay, so the expectancy formula takes into account both losing and winning trades, and that's very, very important. Of course, the number of opportunities you have in a period of time, for example, a month or a week, are the number of proper setups that actually excuse me, satisfy your trading system, or your set of trading systems that you use. It's very important. The higher, the better. Imagine if you have a good reliability, you have an expectancy with 1, or positive expectancy anyway. You want to maximize the number of opportunities. And the full picture is given by the expectunity, which is very simple. It's just the expectancy times the number of opportunities. And this gives you the dollar earned per every dollar risk in the period, not for one trade like the expectancy, but in the period, because it takes into account, very simply, all the opportunities, the number of opportunities that you generate in that period. All right, so very simple concept there, nothing really complex here. So a system that wins a lot, which has a high reliability, might not be that good if the expectancy is not positive. There can be high reliable system that wins 80% of the time, but when they win 1, and then when they lose 5, for example. And in that case, the expectancy could be non-positive or small, in which case we are not interested. And if that's the case, when the expectancy is small, we need to generate more opportunity. So before I say that, people laugh at risking 1%. When I tell them to risk 1% of the capital, some of them accept the concept, they understand the implication, because they understand what comes after that with money management. But some of them, they just look at me and say, seriously, and when all that leverage we have in Forex, and when I'm gonna get into my first million if we only risk 1%? Well, they really do not understand the reality of the markets. And to me, the lovers are out of ignorance, because this is the loser concept that we need to trade a lot in the smaller time frames, or generate as many opportunities as possible, trade the news, trade often. But see, if you think about it, that's not what is necessarily needed for to be successful in trading. That's maybe what the industry wants you to do. Right? You have to trade a lot, you have to trade the news, you have to be involved at all times. Well, I have a different view. And this way of thinking is also the product not only of the industry, the marketing, but it's also the product of a modern society that wants it all and now, and does not value the importance of the gratification of delaying. Now, of course, you can always add more risk. So a lot of people come to me and say, well, this is my risk capital. I'm not going to risk 1%, I'm going to risk 5%. Fine, provided you know what you're doing. Some people risk 10%. Well, be careful now, because one big event can really start wiping you out. Think of the US Swiss franc, what happened the beginning of 2015. So, and some people don't even know how much they are risking. In fact, they actually generate ideas which are discretionary ideas, and obviously more risk always produces higher returns when you still have your capital, because with those potential returns, it more often generates a higher number of basket accounts, 95%. Of accounts in Forex trade, and that's something that you don't want to do. 95% of starting traders lose 2,000s to 6,000s in a period of 3 to 6 months, and that's the reality. That's the current statistic. So the question is, do you want to be in the statistics, or do you want to try to do things differently? And that's the question. So what people ignore is that there are many things that needs to be mastered when it comes to trading. And as Alexander Elder said, any clown can buy and sell a financial security, but the reality is that you cannot trade, you cannot treat trading differently from what it actually is. And trading is a business. It needs to be treated like a business, and if you do business, you need to know the rules of business, which are different from the rules of being employed. And one of them is that you don't take unneeded risks. When you have your own business, you understand that you want to manage risk. You're not dealing with other people's money. You are dealing with your own time and money, and you want to be able to manage risk properly. Okay. Now, the some people tell me, I risk 5% per trade because my capital is risk capital. I have to keep it sitting on the account. If I have to keep it there, I would rather buy a car with it. And now the point is, what must ignore is that it's really the basic of trading. They only look at the mechanics of trading, the method, the entry, the plan. The reality is that you can reach objectives in trading in different ways, and trading has many aspects that you have to master. If you can produce steady monthly gains, you can generate a fortune, and that's the key here. And the way you do that is through techniques of money management. That's how you do that. Okay. And so enter money management here. You reach trading objectives with money management, Vantar. It's not risk management. It's not the method. It's not psychology, although psychology is very, very important in trading and it's required. But whenever you state some objectives, it should be performance objectives or risk containment objectives and so on. Excuse me. The tool you use to reach those objectives is money management. So if you risk 1%, your risk is your one unit of risk here is 1% of your account, and you can make 5 units of risk per month. You can generate large profits in a reasonably small amount of time. And you might ask now, and how do I do that, right? And I'm going to show you some of the techniques here. But before I get into those, I want to continue here and talk about the concept first. Okay, so how do you do that? And we'll get into the numbers in a moment here. Do that by leveraging the power of other people's money, particularly a technique that I learned from Vantar is called markets money layers. Very, very simple. It's not as risky as other techniques, Kelly criterion and optimal F, and you name this. The concept is very, very simple. As you accumulate gains, so obviously you have to have a system which has a positive expectancy, and that is capable of generating gains on a continuous basis. Of course, it's always in terms of average. It's never in terms of, today or this month I'm going to generate X from the market. And one of the reasons people fail in trading is because they bring their employee mindset to trading, which is a business. So if you have a way to accumulate gains, then what you do something very simple. You take larger risk on other people's money, which is the gains, the money extracted from the market. And as simple as this concept can be, a lot of people do not apply it. And when you do this, you can keep risking 1% on your own money and risk more, 2, 3, or 5% on market money. And I'm gonna show you what that means. We're going to do some projection and show what that means for your account. So the beauty of this is that in case of very adverse events, like you risk 10 times your initial risk, right? You may lose a sensible portion of your gains, but only a limited portion of your initial capital, which keeps you in trading. Now, this is a very, very adverse event, but these events happen, and that's something that people who are who think that they can risk large amounts and use leverage, they clearly do not understand or do not believe that these kind of events they can happen to them. And so every time you hear someone risking a large portion of their account or using money management aggressively and using leverage, you should always remind yourself and them that these kind of events can happen, and they happen more often than than what people believe in modern market. So let's look at an example here. If you have an initial 10,000 capital and variable risk, you know, we go back here and let's say that you have you have this amount here. You have you start the first month with 10,000, and let's say that your risk is 1%. So it's going to be our risk here. I'm going to highlight it 1%. I'm going to highlight it in orange, which means that every time we put up a position, the pip distance between our entry and exit has a value which is 1% of our account. In our case, you know, 1% risk would be $100 here. So if every month we gain 5% in average, which means that, you know, some months could be 7, some months could be 10, some months could be 3, some months could be even negative or 0, then in average we will get something which revolves around these numbers here. It should be a little bit higher, but it revolves around this here. So the first month we have $500 in gain, 10,500, and the next month we actually risk 1% of that amount. So we risk a little bit higher, 105, and so on. As you can see, after 12 months with this strategy, we have a 71% gain, okay, which is respectable, considering that we compound risk along with our capital. And again, this is in average, so there'll be some months in which this will be 2 or 3, other months will be 10, other months might be negative, and so on. That's part of trading, of doing trading. Now, if we risk more, and I can show this here, if we risk 2%, obviously the risk is higher, the risk compounds more quickly as well, and also the gains compound more quickly, and you end up with a 185 percent return here. You go from 10,000 to 31, so it's even higher. It's 201, right? That would be your don't have it here, but you basically go from 10,000 to 31, 384,000 here. Now, again, we are keeping constants here. We're saying you generate 5 times the risk in average. And obviously, again, as I mentioned, these are the actual values would be around this plus or minus, because that's the way it works. If one month you do 10% and then the next month you do 3%, obviously those will more or less even out, more or less. It might be less than this, maybe a little bit higher than this, but that's what you get. So the higher you risk, and you don't want to get necessarily there, but obviously the higher you risk, the higher is the return. The question is, can we actually generate higher returns with using a different techniques? Instead of risking 3% on my account, can I do something different? Well, yes, you can use layers, and you can use what is called the money market layers here. And in here, I want to show first an example in which, you know, the example in which we basically risk. So the way first of all, the way the money layers works is that you have 2 different layers, and actually you can have as many layers as you require or you prefer, actually. Okay. Now the first layer here, it's our capital, so it's $10,000. Any gains over and above 10,000 gets into the second layer, which is a money market money layer. For example, when our account is at 10,500, our market money is $500, okay, and so on. Now, as we gain more and more, we can actually risk more on our second layer here, the markets money layer. So instead of risking, for example, 1%, as we did in this example here, and again, I'll go back to 1% here, we generated 71.03%. What we do is we risk, let's say, 1% on our own capital, and we risk much more, for example, 3%, or even more, 4%, 5% on what? On the money market, on the market's money. Okay, so for example, if we risk 3% on the market money here, right? 1% of market money would be $5. In this case, 3% would be $15. And so we add the $100 that we risk on our own capital to the $15 that we risk on markets markets-money here. And as you can see at the very beginning, our risk increases to 150, 115. In the previous example, we had 105. But it is not just a different way of risking here. Simply conceptually, we are risking more on other people's money and less on our money. Okay, and when we do that, we obviously obtain totally different results. In fact, we weigh more here. We go from 10,000 to 24. 501, and before it was only 17. So as you can see, a simple improvement here. Now, if we risk 5% on market money, can you see that the results start growing exponentially here? And as you grow, you could actually have a layer for the first 10,000, then a second layer for the next 10,000, and then a third layer for the following 10,000s, and using a different risk. As your capital grows, you can reorganize your layers in a way that you risk only what is necessary. So you can clearly see here that this technique allows you to compound on by risking more on markets money, and obviously it's a way of seeing and protecting your capital as well. If your market money goes because you're risking more on it and there is an adverse event, remember you still have your capital that you can use for trading. Of course, you don't want to make this risk too big. You don't want to make 10-20% of risk on your market money, or if you become so extreme, you want to do only for a smaller amount of money. And that's the key concept here that I wanted to give you today. And these are not just numbers, because when you have a method that can actually give you an average 5 times your risk per month, and clearly it's a method with a positive expectancy, generate opportunities that actually allow you to get these results, then using the layers, it becomes possible. And obviously, if you have edges that allow you to generate the double of that, and you can generate a lot of opportunities intraday, you can see that this number starts growing very, very quickly, even if you just is 3% on your account. So clearly, the expectancy and the number of opportunities, or the expectunity, are key to this approach, and will determine how quickly you can be successful. But even return like 5 units of risk that we do in the FibStalker trading signals room are actually good enough to actually leverage your results. Okay, so this is the idea here, and if you need a trading method regarding the way market money works, here are some of the expectancy and expectancy that we get when we get the full risk. The basic swing gives us 60% winners, 40% of losers, and they're distributed more or less like this. So we have between 5 to 8 opportunities every month. And typically a winner is 2.5 the loser. So this gives us an opportunity of 7.15, which in average is very close to that 5 unit of risk that we need. If you apply a risk-free approach, and if you want to learn more about risk-free, you can watch some of the presentation in the last few weeks. And there it's slightly different, because when we have the risk-free approach, there are a number of losers that we close to break even as well. So this allows us to reduce the times we get stopped out with a loss, which is only to 20%, but obviously the expectancy goes lower. The advantage of this is that it's easier to stay in the trade, because with a risk, when we manage risk, clearly and we get a risk-free, so we get half of the position out at the risk-free level. There is less pressure on the trade and on the trader as well, and so it's easier to stay with the trade, and we generate less stops with a loss. Of course, we pay that in terms of expectancy and expectancy, but 5.50 is still very close to that 5 unit of risk that we want. Obviously, the great advantage is when we fully use the FibStalker methods with the FibStalking timing technique, which allows us to generate a lot of risk-free trades. And we can have between 20 to 40 opportunities by timing on the 1 hour or 15 minutes, with an average of 30 opportunities. And there, again, there is a different distribution of losers, break-even, and losers, break-even, and winners, which actually the winners have much higher average return to risk, around 40 in average, and the expectancy goes higher, but most importantly, the expectancy goes higher, and we can get a lot of opportunities there, which balance the higher number of losses. So this is an idea. Consider joining the FibStalker trading signal service if you want to generate, or you want to differentiate the way you generate your opportunities. You can go to winningwithalgos.com, or you can drop me an email, and I'll be happy to give you more information. Remember, there's the free course, winningwithalgos.com/start, that you can download, not download, access for free there. All right. Okay, so this was it. I just want to remind you that in the past I spoke about money management a lot on FX Street. So you can go to 2014. I presented the How to Reach Trading Objectives with Money Management, where I explain in more detail risk and money management and the money management layers. You can go there, December the 19th. And before that, in August 2014, I talked about advanced risk management for success in modern markets. So these are free open webinars. Go there and let me have your feedback in relation to this content. All right, and this concludes the first the educational section of this webinar. Thanks for watching. Okay, next I want to quickly review the past recommendations on charts, and in this section, then I'm going to go back, and I'll use my charts, live charts as well, but briefly look at where we are in relation to some of the analysis that were done in the past. I like to be accountable whether things go well or not. As I mentioned before, no method actually wins all the time, and I would like to see this more in the industry, because sometimes, I mean, it's easy to report success. It's certainly less easy to report when the trade do not go in our direction. Now, that said, as I mentioned before, we have the risk-free approach that helps us, not always, but often. It helps us managing our trade. So I will start from, because I spoke about New Zealand dollar, US dollar, Japanese yen, and then again last week. So euro dollar moving to 104. Obviously, that didn't happen. The market its move lower on the day of and here is the chart, on the day of the no referendum in Italy, and so we saw the jerk move lower, and the market then recovered. So the good thing is that at that point, our position was already risk-free, so we were stopped out, but at break-even. That is the important of trading risk-free, using the risk-free method. The same thing actually has happened to the euro, the New Zealand dollar, US dollar. We're looking for lower targets, and again, the trade was risk-free. The trade actually, we got an extension here, which brought price into the risk-free level. That extension that we traded was lows to lows here, and the market participated at 0.7078, but price well below the risk-free level, and then it just reacted higher, and clearly now it's actually reacting higher, and possibly bringing price all the way into the highs to lows here, and we will see whether that happens in the next section as well. There were other recommendations as well. New Zealand dollar, Singapore dollar, on the other hand, is doing very well, and we anticipate this market breaking previous highs maybe tomorrow, and then bringing price into that 104 for first target. So we are actually on the right, let's say, moving in the right direction here. 104.20 is and was and still is our target here. The dollar index target, I mentioned it was 106.30, and let's look at the dollar index here, which came to trade the next extension long, and this extension long, if it's respected and it coincides to previous highs here, will bring price into 103.20 and possibly 105 here, so helping price into that target that we mentioned, the 106.30. So this is still on. And US dollar, Japanese yen, we mentioned US dollar, Japanese yen, we mentioned one level, the 115.62, and this market is still into this area of potential resistance, and that move is still very possible, and there are only two outcomes here. Either this market continues higher into that level and then it starts the reversal, or this market actually starts the reversal and has maybe already started the reversal here, we don't know, which will bring price, which could bring, we don't know if that is going to continue, into the next area of support, which is starting at 110.90 and going down into 109 area here. So 100 pips of area where this market can be potentially picked up. We just need to understand whether that area is going to be tested now or is going to be tested after the 115.62 level that was mentioned in the past is going to be tested. Okay, so for accountability here, it's important always to see why we make some recommendations, where those recommendations are going, and most importantly, to make sure and keep in mind that our method is aligned with the kind of expectancy we anticipate from the method itself. All right, so, and this concludes this part on the reviews of past recommendations. If you find it interesting, please add a link to your Twitter and add the link of this presentation. Next, I want to review a little bit more detail the euro dollar and see where this market has the potential to go here. This market has traded a 50% retrace the prop price into the first target, and we can see that. Let me show it to you very, very clearly. And I will remove dump money as well here. And we had the 50% retrace, which traded and broke price into the first target. I was looking for lower prices as well into the next target, which is above, it's 103.80, so the target would be below 104, which was the level that we were targeting. But clearly, the volume on the downside that was generated here was used probably to take profits on by smart money, to take profits on the dollar, at least temporarily, and so the best guess I have for this market at the moment is the possibility for this market to go and retest next measure move short at 109.03. So this is going to be my the area that I'm going to watch here for this market, and I anticipate if we get there, it's a test for short to see whether we can generate a risk-free trade here around this area, and then try to bring that risk-free trade to target. Okay. And this concludes the review on the euro US dollar. Next, we reviewed this in the past, and again I want to review the US dollar Japanese yen. If you want to join the Winning with Algo's trading FibStalker trading signals, you can go to winningwithalgos.com/signals and you'll find information there. So US dollar Japanese yen, let's look at what and where this market is going, and if this market actually has started a correction, should be a lateral correction and a continuation higher, or if this market is going to come lower. Now we can make a lot of speculations here about what this market is doing, and the point is they are just speculations because we don't know what the market is going to do as well. So far we saw this market moving laterally on top of this area of daily dump money support, which has not been tested yet. And the point is there are two options: either this market tests this area or just consolidates and continues higher into that 115.62 level, or the market comes and uses participation from smart money found in the 110 area here, and participation from dump money to propel this market higher. So I always like to, I don't buy highs, I don't buy a market. I always buy retraces. This retrace will either come before or after we have tested the level. So after and if and after market money is the smart money is out of the way, short is out of the way, this market will be able to retrace. So to me, if I have to give an opinion, although the market does not value my opinions, that this market will go higher first and then correct. And if it goes above this area, then there is a much higher probability that price will be picked up by smart money as well. And we will get ready to do that. So the levels are already there. If that correction happens from these levels, we saw no participation from smart money at these levels. And so the anticipation here is that that participation will not come and price will just continue into 115.62. So that's still the plan here. 110 is going to become our support area if the market has a quick drop into that level. All right. So that's it for the US dollar Japanese yen review. Thanks for watching. And if you want to share this video, you can do it here. Okay, next, I want to review the dollar index futures, and this is of course very, very important. The dollar index has been front and center in the last few weeks, before and after Trump's victory. And for those who have followed my analysis, know that this market has been supported for a little bit more than 1 year. Then there was this failure of bulls, and then soon after that, bears have also failed, as you can see. Soon after that, so this market started moving laterally on top of support. That support, at some point, as you can see here, started being respected. As you can see here, very, very well. And and then the bears were already out of the way here. There was a confirmation here, and then this market, which is not as technical as other markets, but it enjoys a good volume. You could make the case that he traded the next measure move here, and there are different ways of tracing that level. But the main idea is that on the day of the election, there the market either it's very interesting to interpret this move here, either the market moved price lower in anticipation of Clinton winning. It's pretty interesting here. And we know that technology stocks are kind of more friendly to the Democratic, while industrial stocks, generally the industrial company is more friendly to the conservative party. But despite what really happens here, we don't have to explain things. We just need to deal with price. And despite the way you trace this measure move, the next and obviously that would be an inner move if you consider the larger retrace here. The larger retrace was capable of bringing this price into first and second target here. Okay, so what we saw in this move so far this week was basically price trading the next extension short. Okay, so the next extension short has clearly showed support in the 90-80 area here. Okay, so even if this area is retested, if it is retested successfully, we're going to see another leg higher of the dollar index, bringing the dollar index into that 106. Why is that 106 important? When we why I mentioned 106.40, because 106.40 is an area of potential resistance, larger area, and if this move higher is not reversed, that's eventually where we're going to get. And then there's going to be a new test for this market to see whether this market is going to continue higher or is going to move lower here. All right, so this is the analysis for this market. Again, the 99.80 could be retested again. If that happens, you know, this market could just continue higher, and there would be also an opportunity to trade this market on the upside. And this concludes the analysis for the dollar index futures. Okay, the last market I want to review is silver futures, because with the recent correction in the dollar index, this market might be close or retracing into an area that could be interesting for shorting. I want to briefly review this market and show how technical this market has been recently. Actually, since the end of last year, 2015, we had a 50% retrace, first and second target, a new 50% retrace, first and second target, and a new 50% retrace, but this market was already in a sequence of very well formed sequence of measured move shorts here. As you can see, the 20 level here, important psychological level has traded, bringing price into that first target, and then that happened again. So highs to lows as traded and as broke price into first target here. So there are two outcomes. The bears are clearly, the weekly bears are clearly out of the way here. The daily is pushing this price higher, and one obvious area to watch for resistance is going to come at 1770 here, and that's where we are going to see participation here from a potential test and a continuation lower. There's also a possibility for this market to retrace all the way into the 50% here. Now, when we put into the picture the smart money, clearly we can see that we have a lot of that resistance coming right at that 1770. So for me, this would be the best. This would be the best spot if the market gets there to get a low risk trade. And of course, as usual, we want to see confirmation, and we're going to use the FibStalker timing to look for confirmation and see whether price is going to react to this area. But we have weekly dump money, monthly dump money, and we have a smart money, next measure move short. So seems the perfect storm here for a continuation of silver shorts. All right, so this concludes the review of the silver and concludes the show as well. If you are interested in my work, you can come to FibStalkerTrading.com or drop me an email. And I started the November session, which is my 5th session of the FibStalker Methods Coaching Program. If you are interested, I'm launching a new series next year in February and March. If you are interested, let me know, and you can write me at fibstalker@gmail.com. Thanks for watching, and I'll see you next Wednesday, 7 p.m. EST time, here on FX Street. Have a great day. Bye-bye now.